Hello, everyone. My name is William Mucker. I'm a client executive with Camoplan, and I would like to thank you all for joining us today for today's webinar, Investing in Gold and Mining Shares in the Age of Stagflation, Digital Currency, and Geopolitical Uncertainty with Simon Popple of Brookville Capital. As a quick note, please be aware that Simon will be answering questions at the end of the presentation. However, feel free to use the Q&A function on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camoplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any of one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camoplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I would be more than happy to help. And without further ado, I'll pass it over to you, Simon.
Thanks very much. Right. Let me just share my screen and then you can see the presentation and we can take it from there. Right, here we go. Today, I really want to talk to you about investing in gold and mining shares in what I think is going to be quite a challenging time. Inflation, stagflation, we don't really know what it's going to be. There's digital currencies out there. Obviously, they've had an interesting time recently. And geopolitical certainty, I think we all know what that's about. But let me just sort of take you through my thought process. I'm a professional investor, and I just want you to kind of think about the same things that I'm thinking of. I'm 54, so I'm not retired, but I'm not a million miles away from retiring. So I think that what I'm about to say to you is particularly relevant. Anyway, let me just go over what I'm going to cover. As I said earlier, I want to talk about my thought process. Obviously, you're going to be thinking about your investments, and I just want to explain how I think about mine. Then I want to sort of talk about what I like to invest in and why. Spoiler alert, it's going to be gold, but I really want to cover sort of why I think it's interesting in this environment. Also talk about what I like at the moment and why. I think it's important you understand what to look for when you're researching mining companies. So I want to help you with that. Also identify a few red flags. And I don't have a slide for it because it just changes on almost an hourly basis. But I think, at the end of it, we perhaps want to touch on some of the geopolitical developments and sort of new asset classes and, perhaps why the gold price isn't going through the roof at the moment, and mining shares, to be honest, are pretty cheap. Anyway, let's kick off with my thought process. So what I like to do when I start out looking at asset classes is to try and take us what I call a sort of 10,000 feet view, which means, I want to try and look at pretty much everything. Now, I don't have digital assets in this list, largely because they haven't been around that long, and I feel that they sort of slightly distort things. But I like to look at all the different asset classes. And as you can see, this is some research that was done from PIMCO, which would suggest that if we get inflation, which is inflation and growth, commodities could do very well. If we get inflation without growth, then gold could do very well. Clearly, we've got inflation, so I don't think that's up for debate. But whether or not we have growth or not is probably slightly debatable. I don't think we'll have much growth, so I'm erring on the side of gold. But I do have some commodities as well. In case I'm wrong, I like to hedge my bets a bit. And so, we can touch on those as well. having seen that graph, the next thing to do is to start cross-checking things. So what I did is I looked at the Goldman Sachs Commodity Index. Now, several points to note here. First of all, I like to look at indexes over a long period of time. If you look at this over a 1 or 5 year period, you could probably think that you perhaps missed the commodity boat. You can look at the upswing on the right-hand side. But if you look at it over 25 years, which is what I've done, you'll see that you haven't missed the boat. You probably haven't got the best seat on the boat, but you haven't missed it. And therefore, I think commodities are interesting. And, that's one of the reasons why I'm not completely in gold. I've got investments in other areas as well. Now, I think the other thing to realize is commodities, it's a great umbrella term, but different commodities do different things, and you need to be careful about just buying commodities, because in a recession, people buy less stuff, whatever that may be, phones, food, all sorts of different things. You've got less money, so you buy less. And therefore, all commodities are not equal. And so you kind of need to think about which ones are going to be in demand and which ones perhaps less so. Which brings me on to what do I like? Now, as I said earlier, I like gold. But if you like gold, you need to be careful. A lot of people go, I've got exposure to a gold ETF, or I've got physical gold, or whatever. But you need to remember there's lots of different types of exposure to gold, and just having some physical gold or ETF or whatever you've got doesn't necessarily mean that you've got the sort of well-diversified exposure to it. And I think particularly if you're slightly older, you don't want to have masses of risk, and therefore having a diversified portfolio in different areas of the gold market rather than just gold is probably no bad thing. Now, why do I like gold? I actually like it for a lot of different reasons, but I thought you may like to see this chart, because this is, the red line is the current bull market from 2000, and the yellow line is the 1970s bull market. Excuse me. Now, obviously, we don't know if history is going to repeat itself, but I did smile when I saw the red line and just saw it go down recently. Now, obviously, if we get anything like the growth that they had in the 1970s, that would be spectacular for gold. But I think the point is, now could be a very good time to be looking at it. And it's quite interesting. You talk about golden years, as good as gold medal, but very few people have actually got gold. And if that's you, then I think you should seriously think about at least taking a look at it as to whether or not you want some in your portfolio. Now, what I've got now are a few slides that show how gold has performed in a correction. The thing to realize is there's no perfect hedge. If you buy gold, it doesn't guarantee you're going to be fine in a correction. So be careful about what assumptions you make. But what you'll see from the following slides is there have been obviously quite a few corrections, and COMEX gold, now we're talking about physical gold here, not gold mining shares, but you can see how in the next few slides, how gold has performed pretty well when the Dow Industrial Index has taken a hit. So let me just take you through a few of these. 2008, obviously, the Dow took a major hit, down 32%, but gold was up 44%. I'd say that's particularly good. Here's another one. 2011, Dow down 17, COMEX gold up 15. 2008, Dow down 27, gold up 14. 2008 again, but different months, May, July, 18, 17. And then this is a sort of a milder correction, down 7, up 6, and down 18, up 9. Now, all those you can see gold did pretty well. But as I said a few minutes ago, it's not a perfect hedge. And this was going back to the 1980s. Now, one thing I do want to flag is that if you look at what happened to gold in the late 1970s, it had an amazing run. But if you just look at this window, February, March 1980, the Dow went down 21% and gold went down 39%. So by buying gold, you aren't getting any guarantees or anything like that. But I think what I'd say is I like the odds. You know, there's quite a few charts I've shown you where gold's done pretty well. This is one where it hasn't done well. But to me, it makes sense to have at least some in your portfolio. Now, in terms of how to invest in gold, you know, especially in this new environment, I think that there's quite a lot of things to think about. You know, for example, how much risk do you want to take? If you want to take a low amount of risk, then I'd urge you to perhaps just look at physical gold, because then your only risk is the price of gold. If you like higher risk, you could look at producers, because then you've got not just the price of gold, but actually producing it. And if you like, you know, really high risk, then, you know, you can look at exploration, where they're looking for it. They haven't even got the processing plant and the mine in place, let alone producing it. So the gold price is still relevant, but production can be several years away. I think the other thing you need to think about is, you know, why are you doing it? Are you doing it for investment or a form of insurance? And, you know, these are all the kind of things you need to discuss with your professional financial advisor to make sure that, you know, what you're doing is right for you. I then go on to, you know, what vehicle I'm planning to use. I mean, in my case, it's a pension, but you may have a trading account, perhaps a tax efficient vehicle, perhaps some other thing. But if whatever you do, you want to make sure that what you want to invest in is allowable with that vehicle, because there are certain things that aren't allowable, and therefore you need to check what is allowable before you start doing the research and you know, paying for advice. The last thing is tax considerations. Again, I'm not an accountant, but perhaps your financial advisor can give you some tax advice, but it can be very relevant, you know, particularly in the juniors. I mean, one of the companies I told people about, Chalice, went up 65 times. And if you had that in a tax efficient vehicle, you were making a shed load of money and you weren't paying tax on it. But if you didn't have a tax efficient vehicle, you're still making a lot of money, but you're paying an awful lot of tax. So again, you know, it's a relevant consideration to think about. Now, in terms of what I like at the moment, I like to be diversified. So I like physical, I like producers, I like explorers, but as I say, I wouldn't plumb, you know, because I'm 54. I still have some explorers because I like them. I kind of know the market pretty well, and I've been involved for such a long time that I'm prepared to be take a slightly higher risk than many people. But because of my age, I also like to have physical, which I store, and producers. You know, as I said earlier, you know, physical, I'm taking gold price risk. Producers, I'm adding production risk to that, and then explorers, I'm adding exploration risk. So, you know, with explorers, I think it's good to have some, but I would urge you not to have too many. If one comes off, returns can be spectacular, but they can go bust. So I would view it very much as sort of play money rather than you know, serious investment money. I thought this may make you smile. I don't think I'm the only person who thinks that gold is an interesting asset class. This is Chinese and Russian gold reserves, and you can see that over the last sort of 10 years or so, these have started to creep up significantly. And so, you know, I think that a lot of people, a lot of sovereigns, you know, view gold as a serious asset. Now I want to very briefly touch on what I look for when researching mining companies. There's an awful lot that I look at, but what I've tried to do here is summarize it. If you want a deeper dive into it, then I've got a book coming out in January, I think it's going to be. It's an ebook, but that goes into all of this in a lot more detail. But basically, my bridge systems, it's an acronym for balance sheet, resources, infrastructure, diversification, grade, and exploration potential. So just really very briefly, balance sheet, you want to make sure it's right for the company. What I mean by that is, if it's a producer, it's generating cash, a bit of debt could be very efficient. But if it's an explorer, it's not generating cash, a bit of debt, it's got to be paid off. Can be a real concern. Resources, what do they have? Where are they? Are they economic? It's important. Infrastructure, you need to look at what roads, power, and water are available. If there's none available, chances are if they find something, they'll have to pay for it. So that can make what looks like a very attractive project very uneconomic and scare away prospective investors. Diversification, again, I don't like to have all my eggs in one basket, not just in terms of commodities, but also countries as well. I've got huge exposure to sterling because I'm here in the UK. So if your house is in US dollars, you may want to invest in perhaps Australia and Canada as well, as much as anything, just to get some exposure to different currencies. Grade, again, you need to be careful. What's it like? How deep is the ore? A low grade in Nevada could be very economic, whereas a low grade in some parts of Canada could be very uneconomic. So you kind of need to understand a bit about the grade and whether or not it's good for wherever the ore's being found. Now, exploration potential. This is really, I'm using exploration potential for mining companies, but this is really growth potential. And what I mean by this is, if in the case of a mining company, if they've already explored 90% of the tenement and they haven't found anything, then you haven't got a huge amount of potential there because 90% of it's already been looked at. But there's quite a lot of companies out there where pretty much 90% hasn't been looked at, in which case there's great potential. Obviously, they need the money to explore it, but I think with modern technology, you can benefit from more cost-effective ways of looking at land and assessing land. For example, using drones. They used to have to use light aircraft, but obviously drones are a lot more cost-effective, and that can give you a feel for whether there's something that hasn't been found that could be worth a lot of money. A few more thoughts here. The first one is the supply chain for producing gold is very short. Now, if you think about it, once they found the gold, that they need to build the mine and the processing plant. But by the time your doré or whatever you're producing comes out of the processing plant, you've probably created 90, 95, maybe even more percent of the actual value of the gold. If you compare that to, let's say, an iPhone where there's hundreds of different components, all of them are needed to make the phone work. But if they come from all different corners of the earth, there's a famous saying, you only need one product missing to stop a production line. And that's very much the case. So if you've got an iPhone and it's got 1,000 components and you've only got 999, you can't really sell an iPhone without an important component. You can't really say, well, there's everything there apart from the screen or the on button or whatever it is. You need everything. And so that's why I really like gold. It's nice and simple. Now, it's not the only safe haven asset. I think we know that. You've got cash, but if you want cash, then be careful with currencies. Obviously, the US dollar is very strong at the moment, but you need to make sure that you have got a reasonable amount in a bank, but not perhaps too much of anything under the bank. You're still okay. Fixed income, I like it. It's secure, but you need to be careful with inflation. If you're getting 3-4% on your fixed income product, but inflation's running at 10%, it's probably okay for a year, you losing 6-7%. But if that goes on for a couple of years, then losing 6-7% a year on your investment is not good. And then finally, cryptos. Obviously, events this year, it's untested. This week, it's untested. I think that it's an interesting way of diversifying. It's certainly an area that I'm considering, but until prices come down significantly and I've got greater transparency, one of the reasons I like gold is you can't print it, and I think the cryptos, flip of a switch, you could create more, and I like the fact you can't do that with gold. Right, some red flags. If you're new to doing this, I would be very careful if you're offered cheap gold. There's a lot of fraud. It's a bit like buying fine wine. If you buy a nice bottle of wine, you want to know where it's come from, who's been looking after it. And I tend to buy from well-known wine companies here in the UK. So when I come to sell it, I can say, look, it's been held by Berry Brothers or Jeroboam or whoever it is. And quite often it's never left their premises. So sometimes I end up selling it back to them. And the fact that it hasn't left their premises, that they can't question how it's been stored and how it's been looked after and how genuine it is, because it's never left them. So I think that's important. And it's the same with gold. If you're offered cheap gold, why are you getting it at a discount? And when you come to buy it, if you say I bought it from a top gold refiner, it's never left their premises, and you then come to sell it, you probably find you'll get a proper price for it. Whereas if you bought it from someone who's giving you a cracking deal, there's a lot of risk on the part of the buyer, which may mean that you end up having to sell it at the same discount you bought it for. Some other red flags, again, be careful with grade. It may look good, but where is it? As I said earlier, is there an infrastructure around it? How much is there? How deep is it? You need to be a little bit careful about that. Third point, existing infrastructure. I think I've just touched on that. Even if the grade's fantastic and resources in a safe country, is there any existing infrastructure? If there isn't, they'll probably have to pay for it. And the last one really is the track record of the management. Do they have a track record of finding gold? And have they done it recently? Do they have money in the company? It always makes me smile when someone tells me this is the best project on the planet, and they give me all the reasons why it's so good. And then when I ask them, how much of your own money have you got in it? And they say none. You kind of scratch your head a bit and go, well, is that good? How come you haven't got any of your own money in? So I do like to see people having some skin in the game. So if I lose, they lose. Similarly, if I win, they win. So I think it's important to have a sort of an alignment of interests. Now, I haven't got a slide for it because it keeps changing so much, but I think you also need to think about geopolitical situation. If you do want to buy gold producers, gold explorers, need to think about sort of what countries that you like, what the currencies are like. And I think the US, Canada, there's plenty of operations there. So unless you're investing a lot of money, you probably don't need to go outside that, perhaps Australia. But you certainly need to think about geopolitical. Personally, I like, as I said, Canada, US and Australia. There's other countries, there's large parts of Africa that are involved in mining, likewise in Europe, but I like to keep my political risk. I think there's enough risk on the table already without adding political risk to it. So I think that you should definitely consider that And if the grade's spectacular, there's really good infrastructure. Look at where where the gold is and just decide, are you happy with that? And given what's going on in the world, is it a good thing or a bad thing? Or because quite often the market is reasonably efficient, and if it looks cheap, it's cheap for a damn good reason. Anyway, I hope you found that useful, and if you've got any questions, please let me know.
Awesome. Thanks, Simon. Yes, as Simon said, please use the Q&A function for any questions that you may have at the moment. We have one coming in now. This one's from Ellen. I've been reading that the paper market, meaning futures, have been affecting the gold price we see listed on the COMEX. But if you actually now try to buy gold, the premiums are much higher. Your thoughts on this?
Yeah, I mean, I'm very skeptical about paper gold, ETFs as well, to be honest. I would rather own the physical, simply because, if I think the paper to physical ratio is over 100 to 1 at the moment. So if there ever was some sort of Armageddon type situation, I think gold is a form of insurance as much as an investment. And you need to be careful about what you do. So yes, the premiums are going to be higher on physical, but if you're buying it for insurance, even investment, but you don't want to have shed load of it, then I'm much more comfortable with actually having what is known as allocated gold, which means essentially it's got your name on it, and so it can't be appropriated to someone else. I think the other thing I'd say is I like to have gold outside the banking system. So if there ever was some sort of Armageddon type moment, I don't want it to be part of the bank. I want it to be outside the banking system. And perhaps the third thing I'd say is I think it makes sense if you are getting some physical gold and storing it, I'd suggest you store it in your own country. So if you ever need to get your hands on it, the worst thing you can do is get in a car and drive there and pick it up, rather than have to rely on aircraft and all that sort of stuff to get your hands on it.
Awesome. Thank you for that answer. Another question. What type of commodities are you looking at?
I'm looking at sort of a wide range of commodities. I mean, I think that we live in interesting times. The EV market, the electric vehicle market, is obviously very hot at the moment, and so there's things like lithium, cobalt, copper, which if that takes off, can do very well. But I'm also interested in the energy companies, so things like uranium. I'm looking at a LNG company at the moment, but then a few other areas like graphite, I think are interesting as well. So I think you want to, whilst I do like gold a lot, I think it makes sense to have a broad range of commodities.
Awesome. Another question from Ren. Do you manage accounts or do you just advise?
No, I don't manage accounts. I mean, really, I try and avoid advising as well, to be honest. What I'm really here for is educating people. Not many people have invested in gold before, and so what I want to do is to try and help them ask the right questions and think about the right things when they're doing it. And I think that managing accounts is almost a bit cheeky, really, because what is there to manage? I can't control the gold price, and I think that people, if they've bought gold, they've got to pay all the costs, that they should get all the profit. So I don't really believe in that.
Thank you, Simon. Any more questions from the audience? Simon, where can people find you if they think of a question after this webinar?
Yeah, if you go to my website, www.brookvillecapital.com, as I say, I've got a book coming out in January, so there's a pop-up there. If you fill that out, then there'll be a mailing list, so I can just let you know that it's coming out. It's an ebook. So, you know, if you're interested in gold and you want to take a deeper dive, then I think it's a pretty cheap way of doing that. And then if you want to stay on the journey after that, there's other things I can do with you. I've previously written newsletters and things like that. But what I found doing that is I've been quite shocked at people's lack of investment experience. So what I really want to do is to try and help people kind of get a better understanding of the market and you know, help them make their own decisions.
Perfect. And we have another question. The energy and agriculture ETFs have risen, but not gold stocks. Why are those commodities increasing, but not the gold stocks?
Yeah, good question. I mean, I think that a lot of it really goes down to energy. I mean, energy is used in all walks of life. I mean, not just heating your house and driving your car, but, you know, it's used to make stuff, you know, to make your food and to make lots of things in your life. Not only make things, but also distribute them. And then obviously the storage energy is needed for storage as well. So I think that they've done well. Farmland, you can't make it, and I think that there's a limited supply of farmland. You know, I'm a great believer in farmland. I think it's a great asset class, and you know, the gold price, you know, it hasn't moved that much. I agree, but I think therein lies the opportunity. I think there's if gold was sort of $3,000-4,000 an ounce, then I'd be quite nervous about suggesting people get into the market, because I'm not saying it wouldn't go higher, but where it is at the moment, I think it's particularly attractive.
Perfect. Thank you for the answer. Any more questions before we let Simon go for the day? All right. Not seeing any more questions come in, but yeah, please feel free to go to the website Simon mentioned. That's www.brookvillecapital.com.
That's the one, yeah. If you go there, there's quite a few slides from the presentation. Also got my email address, so I'm more than happy to send you this deck if that's going to be helpful. And yeah, you know, I can help you on your journey if you're interested in investing in sort of gold and commodities.
All right. Listen, thank you so much, Simon, for lending your time and presenting this information to us today. And thank you for everybody in attendance. This webinar is recorded, so there will be more people watching this as it gets sent out to all the registrants. But yeah, thank you everyone one more time.
Thanks very much. Bye.
Take care.